Hello, welcome to Rational Investing. Thanks so much for watching. It is way too late Eastern time. I just landed from a 5-hour flight. I probably should go to bed, but I can't sleep. So we're going to talk stocks. Why? Because I'm addicted to stocks. Let's kick this off with the S&P 500. Where are we? State of the state, kind of speak. It's 6,000 roughly is the S&P 500 currently. If we take a look at earnings ratio, the S&P 500 earnings ratio is currently 200. It's expecting 250, and you'll notice a nice jump here from say 100 in early 2018 or so. It really doubled with kind of earnings expansion, mostly driven by the Mag 7, and then some inflationary pressure that's driving up nominal earnings, which these are. It's not real earnings, but it's definitely driving up earnings. And as you know, the stock market is a multiple of earnings. So if earnings go up $1 and it's trading at 20 times earnings, the stock market goes up 20 times. That's generally how it works. We're expecting 250 is the earnings target per share on the S&P 500. We'll see what happens, but that's currently yielding about 6,000 as the S&P 500. If we look at the ratio of price to earnings ratio of the S&P 500, it's basically 30 times, which is one standard deviation away from the average. And we can see this average going back to 1871, a long time. 20 times seems like an appropriate amount to pay for a publicly traded company, an index. We're at 30, so that's 50% higher than the index has been historically. It's kind of testing that upper bound. That's definitely high. You can see in the last 100 plus years, it really has only been testing this upper bound in the last, say, 20 years. Shockingly, that's when we had the tech bubble here, when it tested it and then reverted back down. And also you had the great financial crisis, fine, that might be a little distortion. But then also the rest of this is when interest rates were zero and money's free, there's no cost to hold long term. So you're going to be much more willing to bet long term. That means equities. That demand for equities drives up the price earnings ratio and puts us into a rather abnormal period when you look historically where the ratios have been compared to the last 20 years. Definitely something different. Take a look at the Case-Shiller PE ratio, and this is the PE ratio, but taking 10 years of earnings and normalizing for inflation. Here we're breaching the first standard deviation, now at 38 times earnings, where it should have been about 17 times. So to context, I don't know if that means we're going to go down. It just means we're very high, and you're going to find it much harder to find real cash flowing assets that we look for at this channel. As one would expect, with the price earnings ratio high, you're going to have very low dividend yield. So we're at 1.25, which is very, very low, and that low is below one standard deviation of what would be the mean of 2.8% or so on average. Long term, the S&P 500 should generally have a dividend yield of about 2.5% to 3%. We're at 1.25%. I think that really denotes the mix of the S&P 500. They've been changing that mix over the last 5 or 6 years. Much heavier tech, much heavier growth prospects. That comes with higher multiples. That comes with lower yields. So some of this is a little bit of just changing the makeup of the S&P. It's going to change the underlying characteristics. I like this slide a lot. Very, very interesting. So the pink area, the pink lines that you're seeing here, the super high, that is the forward PE ratio of the Megacap stocks. So that is your Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla. Both classes of Alphabet as well are included here. So this is the high flyers, the $1 trillion club outside of Berkshire Hathaway. The $1 trillion club is really driving the market multiple higher. These things are sitting at 30, 32, 34 times forward PE multiples. That's next year's earnings divided by current price. The rest of the market is lagging significantly behind. You look at the large cap stocks, your Coca-Colas, your Procter and Gamble's, your Caterpillars, your Exxon Mobil's, your Johnson & Johnson's, your Clorox's. These guys are trading at 22 times earnings. So, what's that? Almost a 40% haircut for the growth or the lack of growth that they have. And then below that, man, mid cap, small cap, 16 times earnings. I bet you're going to find some cash flowing deals down there, some high yielding cash flow companies that are under the radar, low debt, strong growth, high free cash flow rates, buying back stock. That's what we're going to try to find this year. We're going to really try to hunt out truly cash flowing companies and present them to you for your consideration. Forward PE multiple for context, the greater S&P 500 sitting at 22%, again with these Mag 7 really ripping the whole thing higher at 30%. So for those of you that are new on the channel here, I'm a CFO by profession. I run companies for private equity groups, and as a hobby, I like having a YouTube channel and teach people how to run numbers and buy companies and cash flowing businesses. We do this at private equity all the time. We look for businesses that are truly generating cash flow and have defensive positions, and I can teach you how to do that in the public market. And that's what we do. We come out with a stock hopefully once a week and kind of present it to you. We lay out for the 5 key factors, right? We look for something that's growing top line revenue. We want to see earnings growth that's enterprise level earnings. We use EBITDA as a prospect, but it could be operating income. It's just the same. It's not earnings per share. You want enterprise level earnings growing. You want low debt, so you want a stock that's got low debt on a debt to GDP ratio, a debt to EBITDA ratio of less than 3 times. We can get into more of that later. You want something that's got high free cash flow. So you generate you grow revenue, your earnings grow, that earnings translates into free cash flow from operations, so you're not playing games with the way you expense items on the P&L, but they're actually cash costs. You'd like to see low capex, so a lot of the free cash flow translates into cash flow for the equity holders, which is what you value stocks on. And that's what we try to do, is point them out here. So we're going to continue to make content for you, continue to throw out new stock ideas. I look forward to communicating with you all in the comments. And let's find some great stocks. It's 2025, it's a new year, new administration. Let's figure out what we can buy, where we can put our money to make some cash flow. All right, guys, good luck, happy hunting. Throw some comments down below on what you'd like to see me review. All right, take care, bye-bye.